It's more or less an open secret that a number of Nigerian banks are shouldering a huge burden of bad debts. The CBN's approved limit for non-performing loans is 5%, but virtually all the banks facing challenges at the moment are said to have built up a bad debt profile of 15%, which is threatening their capital base. With its new directive, the Apex Bank is now targeting the shareholders of the affected banks.
I think it's a welcome development. As with any other business, if your business is not doing very well, then you can't pay out returns to your shareholders or the investors or stakeholders who have invested in the company, especially also if you're a listed company. It also becomes more important, and especially so if you're a bank.
In all, it's just a way of trying to make the banking sector healthy, because if loans go bust, it can affect the general economy. So I think the CBN is just trying to make the banking sector economy so that they can actually retain some earnings to cover that. But what they're also saying is that some banks have improved over time, and so it's also good to actually allow shareholders to benefit from the earnings of the bank. So across the banks, if you look at it well, First Bank till now can't pay dividend, as a First Bank as a bank can't pay dividend. Diamond Bank too can't pay dividend because their capital adequacy ratio is below the minimum. It's a systematically important bank, so minimum is 16%, but it's about 15.8. The other guys like Fidelity, FCMB, Stanbic, ETI, before they had these issues where they can only pay about 30% of their dividend. But with this new law now, they are allowed to pay more than 75%. But there's some banks that are fine, which they can even pay a lot if they want to. So you like the likes of Zenith Bank, GT Bank, Access Bank, UBA, which are actually still in line and can pay dividend because their NPL is lower than 5% and their capital adequacy ratio is above the regulatory minimum.
For a long time, the CBN had maintained that the size of the non-performing loans of Nigerian banks was nothing to worry about and that the situation was manageable. But with things failing to improve, the Apex Bank began moving to address the problem. In 2016, it had to intervene with substantial injection of funds to save one of the commercial banks in the country from going bankrupt under the yoke of a huge bad debt stock. Analysts say its latest action is necessary to rebuild confidence in the country's financial sector.
With these two, banks will be forced to clean up their books as fast as possible so that they can start to pay earnings. Another side is that we're moving towards IFRS 9, which is the new guideline. I think that's the one that is even more of an impact. So from 1st of January, banks are meant to start to adopt IFRS 9, meaning that before a loss incurs, you're meant to start to provide. So you're moving from incurred losses to expected. So what that means is that your outlook on sectors in the next 2 years or 3 years will guide how much you have to start to provide for some of those loans you're giving those sectors. So in the long run, it just means that we're going to have like a more healthy banks that can actually withstand any economic downturn or shortfall.
The loan growth for the last year on year for banks has been zero. So banks are not lending, and even if they're lending at such a high rate of interest that close to 30% or exceeding 30%, that it's not viable for any business to borrow at that rate and survive, at least on a long-term basis. And the sort of money you need to be able to expand or grow an economy will be more of the long-term funds, which these banks obviously cannot provide. So the implication of that is that the Nigeria's growth and our economic recovery plan obviously will be delayed because the stimulus that the banks provide to the economy in terms of finance will no longer be there.
The directive is coming barely a week to the release of the annual reports by commercial banks and discount houses in the country. How the directive will impact the report remains to be seen. But analysts are warning the Nigerian banks may have to shore up their capital base this year to remain competitive and meet their obligations. Ngozi Okoye, TV 360, Lagos.